All right, let's continue the conversation at the Nigerian Stock Exchange as we take a look at how investors can navigate through the volatilities in the Nigerian equities market. And to take a look at this with me is the chief dealer, Andy Tsaku at Kare Capital Trust Limited. Thank you for your time on the program.
Great pleasure, Frank.
I know a lot of people are saying, how can Nigeria navigate through this volatility, especially now that there are so many projections, especially from the World Bank, that Nigeria is expected to grow not more than 2.5%. What are your expectations, especially those of you in the equities market or the capital market, to say?
Yeah, well, first and foremost, the issue of volatility is a universal phenomenon, and it's characteristic of all markets. So you have upswings, you have downswings, and then you have moderate cycles. So it's not a unique feature or phenomenon for the Nigerian capital market. So by and large, what does happen is that volatility itself is a fact of life, and you continue to see this kind of gyrations taking place. If you look at it from the perspective of growth usually is anchored on a number of variables, and much of that has to do with the productive capacity of the economy. And production stems from what? From work that people do. And whether it is products or services, all of these go into defining the level of growth at the end of the day that the economy will witness. And by and large, the wealth of nations is determined by their productive capacity. So if there's reduced production, whether of goods or services, at any given point, it's only an indication of the strength of the economy. So some factors do inhibit growth. For example, you talk about the power constraint that the economy has. And it's been looming large for a long time, even though government is making effort to kind of make it better. A number of things revolve around that productive capacity. So by and large, until we're able to get some of these key things in place, growth will remain at the lowest of, so to say, low levels, as we continue. So the equities market is just a subset of the entire economy. Mm-hmm. But of course, it does mirror what happens in the real economy. Don't forget that the companies that are listed on the bourse are part of the economy. If they are doing well, the numbers will show. But they're also not doing well because of the vagaries in the economy. Then you don't expect the market to do that well. So it's basically a mirror effect that you see.
Apart from the issue of the factor, one of the factors you mentioned is the power, if that has to be addressed. We know that is an issue that we have to do with here, especially in Nigeria. And a lot of people have also looked at the fact that could there be any other factors, especially in the local market? We know the global market could be triggered, weaknesses in the global market or in the global economy could be triggered with some other factors, just like we know of the China and the US trade talks and tensions that would, but locally here, what are the major factors, affecting or controlling the sentiment in the market?
You can address the issue from both the macro and the micro dimension. At the macro level, government provides the enabling environment, right? That is to an extent being threatened on 2 or 3 fronts. The first plank is your revenue base. One of the major sources of our foreign exchange earning remains what? Oil. And we've had to deal with the reality about the fact that Nigeria has little control over oil, particularly when it comes to determining the price. Indeed, even the production level is no longer within the absolute control of government. Why? Because you have threats to production, whether it's coming from militancy effects or the breakage or vandalization of pipelines and all that. All of those go to exert considerable constraint on the level of production that you have. But even if you're even able to produce at maximum capacity, you also have the extended constraint of opaque regulation within which you need to abide in order to ensure that there's no distortion in the level of supply, to the oil market. So some of those factors, yes, may not be within the reach of government, but they are essential. As an example, we're already talking about 2019 budget.
That's right.
Being pegged at $60 per barrel. Events in the recent weeks or months have shown that that target is being threatened as we speak. Yes, the budget may not have been passed, but that is the reference price. And we've seen oil price cascading below 60 level already. Right. What does that tell you? It simply means that, by and large, before you even get started on this journey of 2019, the budget, your expected revenue target is already being threatened. Now, if you're unable to realize the significant revenue that will drive issues around infrastructure, power, and the like, you cannot travel that far. So internally, we've got those constraints. Now, if you bring in the political climate that we're in right now, the electioneering period, a lot of energy is being focused on that. Activities around electioneering and all that it involves have taken some shine away from reproduction. Government is almost at a standstill because the gladiators are out there on the stages, whether they're doing tele-promos or campaign rallies roundabout town. Those things have a way of telling on the functioning of government, and government remains a key driver of business in Nigeria, even though government is said to have little to do with business, but the enabling environment is created by them. So by and large, all of these sentiments have a way of telling on the psyche of an average investor. Some of the challenges that have also extended beyond just the electioneering is the uncertainty that it has brought along. And quite a number of investors are wary and have lost some confidence in terms of the stability of the polity, and have chosen to take refuge in what they consider safer climes for the moment. But that is, to me, some kind of psychological disposition. Why? Elections remain a singular event in the economy. It will come and go.
That's right.
Okay, so in a few months' time, everything about electioneering and 2019 will be in the past. The nation will continue. And that is where I think investors should be more focused on. Look beyond the horizon. Okay, the clouds are here, but there will be rain after the clouds.
That's right.
So what we need to do is to ask ourselves genuine questions. The investment that people are making, are there potentials in them or not? Do you see the companies that you have invested in a few months back, some years back, doing better? Take Dangote Cement as an example. Do you think elections of 2019 will change the business scope of Dangote Cement? Or is it Nigeria Breweries you want to talk about? Or is it a Zenith Bank or a GT Bank? So those emotions, as real as they may sound or feel, investors must look beyond the emotional disposition of who comes in and who goes out. Yes, there's a telling effect in all of this, but the counterpoint I'm making is that elections will come and go. By May, a president will be sworn in, whether it's a sitting president or a new president for that matter. The entity called Nigeria is going to remain a country with great potential that we know, in spite of the headwinds or tailwinds that we tend to experience. The economy will still continue. So growth trajectories globally for this year don't seem to suggest that, and coming from the IMF and other postulations, they don't suggest that the world is going to enjoy so much robust growth. We have crisis in the Eurozone at the moment as we speak. The UK is still battling with the issues of Brexit, not to talk of the war talks between US and China. So everything tends to suggest that there's a slowing effect across board, across economies. So by and large, investors, no matter how you try to reshuffle positions or portfolios, there is still opportunity across board for investors to make some gains. And
because that brings us to the next question. You've already said in your earlier analysis that investors are losing confidence in the market, and of course you also said how the investors should look beyond, of course, the cloud as well. So the next question will be, how can they take advantage of the market? That's another question, because some might be watching us. Okay, how do I navigate? How do I take position? What are some of these sectors to look at to take advantage of in the equities market? Or should I diversify? These are some of the questions looking at the fact that the reality is that the market is really volatile at the moment, and no investors really want to lost a huge amount of his investment in the market.
It's life is all about what? Taking risk. The extreme points of risk is uncertainty. Nobody likes to deal with an uncertain situation. But uncertainty is also a feature of life that only God understands.
That's right.
Okay, but when it comes to dealing with risk, you've got to analyze the risk. You've got to know what level of risk are you willing to take. It is not just about jumping into the ocean where you've not taken basic lessons in how to swim. Okay, so the risks are imminent, the risks are realistic, and it is important first and foremost for an average investor to seek guidance, and that's why you have professionals. Okay, so it is not sufficient for you to say, I want to make an investment and then just jump into the waters. Get to be acquainted with at least one professional in the market that can guide you. The starting block will be to even understand your psychology of investment. Do you have a short-term view? Do you have a long-term view? Quite a number of people just go by the bandwagon effect. Oh, Mr. A tells me, last month I put some money into this stock. This month I've gotten this kind of gain. You say, oh, that's fine. It looks like it's attractive. Well, you may not have a repeat performance of that experience, but that doesn't mean you've taken a wrong step in the first place, okay? Because every investment has its own gestation period. If you look at it from the farmer's perspective, if you sow corn, the gestation period to grow corn is different from that one that you will grow rubber or cocoa. So the fact that you've not harvested cocoa in the first year of planting doesn't mean the seed is bad. That's how investments play out. You need to understand what you're doing. First of all, what are your objectives? They must be clearly defined. Are you investing for dividends? Are you investing for capital appreciation? Are you investing for some other considerations? Those are the kind of discussions you will want to have with your advisor or your professional party that you want to get acquainted with. A lot of others who on their own, by training and by experience, are already sophisticated. They are themselves their own professionals, so they don't need, or they need less of any other person's guidance. But of course, there's a rub-on effect when there are shared opinions. Key to any investment decision is what? Information. Quite a number of investors act on the basis of emotions and sentiments. They are not particularly guided as to information. What do I mean by information?
What are some of this information?
The basic financial standing of any company must be known to you before you take an investment decision to put money in that company. So it's called fundamental analysis, right? So you've got to have what is fundamental. You want to put money, for example, in a GT. You need to understand who are the people behind GT. What kind of management or board constitutes this entity called GT Bank? What has been their track record over the years in terms of performance? What is their history of rewarding their investors, not just board and management? Dividend history, bonuses, capital appreciation, those are key issues you need to be acquainted with. But that you woke up one stock traded X price, the next day jump to Y price, it's not sufficient reason for you to jump into. And we've got classic examples in the market where we've seen a few stocks, trending upwards for some unaccounted reasons, and then you jump into. Now, before you get in, those that were in already are taking a bow, and you're left with it in your hands, and you're wondering, oh, what happened? Nothing happened. It's just that you were just looking and never internalizing the facts around the occurrence.
Interesting. But then, just before we take a short break, I just want us to look at. I know that some investors will like to know, as a result of some sectors that are performing well than others. So for instance, the oil and gas industry, and in 2018 we've seen the financial industry, the banking sector in the equities market dominated trading activities in the market. So this is 2019, of course.
Yes.
Are we likely to see a trend like this, like that in the market, looking at a particular sector, dominating trades or activities?
Well, the domino effects, as I would choose to describe it, as to the performance of sectors, stems largely from the composition itself in the first instance. For example, you'll discover that the banking stocks have great dominance of performance in the market, in our market historically. That's also followed by the industrial and then the consumer group. So these three key sectors, whichever way you look at it, whether market is down or uptrending, they tend to dominate the market. One, because of their relative size in the basket, and secondly, the level of liquidity that they enjoy. So come rain, come shine, they will continue to play a dominant role. One of the good things about those sectors that investors can quickly align with is the fact that when you need to exit a stock, which is usually a test of liquidity, how easy are you able to navigate? Because there's no point holding an asset that you cannot realize it when you want to. And that's one of the benefits of liquidity in a stock, which is also a factor that investors should always look at when making investment. If I buy stock A today and by tomorrow I choose to exit for whatever reason, can I easily come out of it? Not every stock offers you that latitude. There are some stocks you probably will get in and you want to get out, you're stuck. Probably stuck for a generation. Okay, so, and that's not the best in an investment decision, because when people make investment, they're actually exercising a choice of delayed gratification. So, but the day you choose to gratify yourself from that same investment or asset class, you should be able to exit it. So we continue to see dominance coming from the industrial space, the likes of Dangote Cement, flour, sugar, NASCON, and then the banking space, play a key role. You take tier 1 banks, tier 2 banks, all of them constitute a formidable size of our market. If you take those three sectors, of course, to mention the likes of Nestle, Nigeria Breweries, and the like, by the time you have those three sectors aggregated, you're already talking in excess of 60s to 65% of the entire market.
So just a quick one now. When you say take two bank and takes one bank, how do you mean?
No, I was making reference to tier 1 banks, and you're talking of the likes of First Bank, GT, Zenith, Access, and UBA.
That's the four,
Tier
the first five big
four
banks
leading
now.
banks, or five
Okay.
leading banks, as it were. And then, the tier two banks are the lower cap banks: Sterling, FCMB, Fidelity, Diamonds, because Diamond is still on the basket,
That's right.
even though we know the marriages are about to be consummated. So those ones form the tier two banks. But of course, they all form the banking space, as it were.
Let's quickly take a moment now. We're back. Join us again. We're back in the second half now. Let's quickly continue the conversation. And Andy Tsaku, Chief Dealer at Kare Capital Trust and Securities Limited, is still here with me at the Nigerian Stock Exchange here. Thank you for your time. I was going to ask you earlier, but now let's discuss it in the second half of the program. You said that the $60 benchmark in the 2019 budget has been threatened currently. So, is there hope for Nigeria, looking at the fact that we're beginning to see very shaky in prices of crude oil in the international market, and looking at the fact that OPEC is to cut some of the production output for the first half of 2019? And so what are the risks that might likely we may face as a nation, looking at the fact that that $60 benchmark in the 2019 is currently being threatened by the prices of oil?
Well, you see, the beauty about any budget is the fact that it's a plan. It's a plan that you intend to carry on, all things being equal. All we're saying about the reference price being $60 per barrel, forming the benchmark, is the fact that if the reality in the market space turns out to be less than that, it simply tells you what? You will have less revenue to drive whatever you want to drive in the course of the year. And that's a reality that you cannot shy away from. Unfortunately, you can't also impose a price because it's outside your control, it's outside anybody's control. The best, projections that are made are based on all things being equal. But we've seen that all things have never actually been equal in all seasons, at all times, in the dimensions that are perceived. Okay, so if we're unable to achieve that target, it certainly will have effect on whatever you intended to spend the money on. For example, if you've budgeted to spend money on capital expenditure, whether it is roads or railways and all that, by an amount, within the course of the year, you will not be able to achieve it. Now, the other thing to look at is, okay, supposing you're unable to realize all of that from oil, what other dimensions of the economy can ignite activity and growth to the extent that you'll be able to fill the gaps? More lately, we're beginning to see that the government is doing a lot more with reference to taxation. And I do think that particularly the FIRS has done significant growth as to how much it's been able to scoop, from the same resource base. And we've seen a quantum leap in the level of financing that can support government spending coming from taxation. Not because businesses have expanded significantly, but a lot more people are being brought into the tax bracket, whether it's corporates or individuals or as it were. So it is that kind of thinking that will affect the extent of growth, or hope, as you chose to call it. The business of government is not just to spend, but to think of how to generate the revenues to support the spending capacity.
That's right.
So if you choose to spend X amount, how much are you generating? Okay, without necessarily tasking both businesses and individuals beyond necessary limits. Because yes, you may want to increase tax levels or the consistency of tax payments, but is it at the detriment of growth, the same growth you're trying to ignite?
That's right.
You can stifle growth if taxation becomes a major deterrent, or it can act, I mean, as positive as it is, it can also be a disincentive, to businesses, because that would just be one component of cost to production. So
That's right.
it is important that the government does what is necessary within the limits of resources. There's been a lot of talk around diversification,
That's right.
agriculture being one of the singled out dimension, but it also now depends on which dimension of agri you're focusing on, because it is not every agricultural event that will translate into an annual output, not to talk of revenue. So yes, over the long haul, you can improve production in agri. Rice production, for example, can be, contained within an accounting year or a financial year or a fiscal year, as it were. But if you're investing long term, plantations, you're going to reap the dividends of such investments over a longer haul, and that will not translate into your annual budget. But we need to rethink our psyche and everything of our planning beyond the horizon of annual budgeting.
But would you say that we're a bit too ambitious as a nation with that $60 benchmark?
Not necessarily. Again,
Of course, given the fact that
the
the financing and debt servicing may rise in this 2019 or the first half of 2019.
the burden of debt is not so much the size of the debt. It's more about what you do with what you borrow. Now, if you've borrowed money, whether at the individual level, corporate level, or national level, and you're utilizing such money to generate more money, you don't lose sleep over it. America today still remains the highest borrowing nation worldwide. And people are still interested in taking more money today, if they would ask. Why? Because they're able to convert such debt into production, into enhanced value. That's where we need to focus on, not so much the size of the debt. And that takes me back to the issue of whether the benchmark would give us or deliver to us exactly what we want or not. If you're unable to generate sufficient revenues from oil, do you have the credibility, the capacity to borrow and utilize such funds for enhanced value for the citizenry? That's the business of government. The problem does arise because usually when we borrow or we have borrowed in the past, we can hardly trace the debt to an activity that creates value for the common man. That's really the burden. If you're borrowing and investing in healthcare, in education, in the general well-being of people, in infrastructure, these are things that translate into enhanced value both for the individual and for the nation at large. So I don't have any worries about dollar price be 60. Of course, if we get 100, that will be fine, but that's like a wishy-wash, okay? The issue, even if you earn $100 per barrel and it is not put into productive capacity, you will soon end up eating it up for as long as it ends up in consumption. Don't forget there was a time we had excess crude reserves.
That's right.
Did we not fritter it? We did. So yes, as good as it sounds, there's a threat to the benchmark, but much more. Whatever we're able to scoop from oil, can it deliver to us some value? I think that's a more critical question.
Okay, let's wrap up now. Your parting shot, especially in the for investors who are playing in this market, especially the domestic investors, as we go into the election proper.
I do think that the market at the moment is at its lowest ebb in a very long time. Most of the prices you see now replicate the kind of level of prices we saw a couple of years back. So an investor that is savvy and is interested in making incursion into the market, if you are not already in, please join the boat. because some of the prices you see now, you may not see post-election. Yes, this quarter and possibly part of next quarter may prove tough. But like I said earlier, look beyond the clouds, look beyond the current horizon. Elections will come and go. The market will remain. The companies will remain. And I do hope that they will do a lot more better than what we're seeing. So it's time for investors who have not left the level of sentiments and emotions to begin to rethink an entry into the market and take possession.